Imagine you have this exact amount, just $100, sitting in your checking account right now. Now, you could go spend it on a nice dinner, or you could just let it sit there gathering dust. But here is the thing that most beginners completely miss. You do not need to be rich, and you definitely don't need some insider Wall Street connection to take that money and buy a tiny piece of America's biggest businesses. So, here's our roadmap for today. First up, we're looking at the financial foundation. Second, we'll answer what a stock actually is. Third, choosing the right account. Fourth, the danger of market hype. And finally, the boring wealth strategy. Let's get right into step 1. Section 1, the financial foundation. Before you invest. Listen, before we even think about looking at a single stock ticker, we have to look at your current financial reality to make sure you're actually ready to play this game safely. Because, buying a stock takes literally 2 seconds, but building real wealth, that takes decades. Look at it this way. On one side, you've got known costs like high-interest credit card debt. On the other side, you have the stock market, which only offers unguaranteed returns. Paying off that expensive debt and building up a solid emergency fund absolutely has to come first. Why? Because the interest you pay on credit cards is a guaranteed loss, while market gains are never a sure thing. Plus, you really want cash on hand, so you're never forced to sell your investments at exactly the wrong time just to cover a sudden unexpected bill. Moving on to Section 2. What exactly is a stock? Owning a tiny piece. To really answer this, we need to strip away all the complicated math and get right down to the core of what you're actually buying when you tap submit on your brokerage app. So what exactly is a stock? Now, I know it sounds like a super basic question, right? But the way you answer it completely dictates your level of risk and your potential reward. It shifts your entire mindset. Here's the deal. When you buy a stock or a share, you're literally buying an ownership interest in a company, just divided up into tiny little pieces. You have to remember, a stock is not a savings account. It is a tiny piece of a living, breathing business. So this means its value can increase if the company grows and investors value it more highly, which is great. But, and this is the part beginners so often forget, it can also lose value if the company struggles, if expectations change, or if the broader market just takes a hit. Remember, potential reward always comes with risk. So you're probably wondering, how do we actually manage that risk? Well, instead of spending your first week trying to find the next Amazon or Tesla and risking your whole entire budget on just one slice of the pie, you can use diversified investments. Think broad market index funds or ETFs. Basically, these tools spread your money across hundreds, sometimes thousands of companies all at once. That way, if one single business fails, it doesn't automatically wipe out your entire portfolio. It drastically reduces your overall danger. It's kind of like not putting all your eggs in one basket. All right, Section 3, choosing the right account. Where to hold it. This is a super crucial decision that beginners almost always overlook. I want you to think of your account structure as the container, and your investments as the actual contents inside. For example, a 401k or an IRA isn't a stock itself, it's just the bucket holding the stock. And depending on your personal situation, the tax rules and benefits of that container matter almost as much as the actual investments you choose to put inside it. Just take a look at these 2026 IRS limits for a second. A 401k lets you contribute up to $24,500, while an IRA sits at $7,500. Now, don't worry about memorizing these exact numbers, that's not the point. The crucial takeaway here is recognizing the massive opportunity on the table. If you are casually ignoring a 401k employer match because you're busy hunting for the quote-unquote perfect stock, you are literally leaving free money behind. That match is essentially extra cash from your workplace just for participating. Oh, and if you do opt for a standard brokerage account outside of work, pay super close attention to whether you're using a cash account or a margin account. Margin means borrowing money, and trust me, that can drastically magnify your losses. Stick to cash when you're starting out. Which brings us to Section 4, the danger of market hype. Avoid emotional traps. Here is where the human element totally ruins the math, and we really have to confront the psychological traps that can destroy even the best beginner strategies. Imagine you start investing when the market is climbing. You're feeling on top of the world, but then, bam, stocks suddenly drop 20%. Fear immediately takes over. If your strategy isn't strong enough to survive your own emotions, you might panic sell, thinking the crash is just going to keep getting worse. Then, months later, the market recovers, you feel like you missed out, and you end up buying back in at a way higher price. You've essentially just turned a really sound long-term strategy into a series of emotional, wealth-destroying decisions. And it's not just your emotions quietly working against you, it's also fees. According to the SEC, these seemingly tiny differences in fees, say 0.25% versus a flat 1%, can drastically alter your long-term portfolio value. It might not look like much today, but over decades, a fraction of a percent compounds into a massive, massive sum. You absolutely must always understand what you're paying for, why you're paying it, and exactly how it's going to impact your long-term results. And then, of course, there is the ultimate temptation. When social media promises a stock is going to completely 10x because of artificial intelligence, or some influencer insists a company is about to explode, you have to remember this golden rule. Excitement is not research. A popular stock can absolutely still fall. And some stranger online telling you what they're buying, that doesn't automatically mean they understand your personal financial situation, your goals, or your risk tolerance. All right, our last stop, Section 5, the boring wealth strategy, the real roadmap. This brings us to the ultimate secret that most financial influencers really, really don't want you to know. Are you ready? Successful investing is actually incredibly boring. Here is the real roadmap. Number 1, build your foundation by managing expensive debt. 2, choose the right account. 3, select a diversified approach. And 4, build the habit and just invest consistently. If you start with an amount that actually fits your plan, say just $100 a month, and you repeat the systematic process for decades, you give compounding the time it desperately needs to work. Money goes in, investments are purchased, time passes, markets move, and the process just quietly continues. Because when a crash inevitably happens, and trust me, it definitely will, the difference between the gambler on one side and the investor on the other becomes glaringly obvious. The gambler needs perfect predictions and needs their money by next month, so a market crash is catastrophic for them. But the investor, they focus on a long-term goal. They position themselves to easily withstand short-term volatility because their strategy simply doesn't require perfectly predicting tomorrow's headlines. So let's just quickly summarize those beginner traps one more time so they really stick. You want to avoid investing money that you're going to need immediately. Stop ignoring high-interest debt. And please, whatever you do, don't put everything into one single stock. Try to avoid buying just based on social media promises, don't ignore those long-term fees, and stop trading on every tiny little market movement expecting to get rich quickly. At the end of the day, all of these mistakes stem from the exact same underlying problem, treating the stock market like a quick shortcut rather than a long-term financial process. I absolutely love this quote from our source material today, and it just perfectly captures the entire essence of this explainer. Building wealth isn't about finding one perfect stock. It's about understanding the game and having the patience to play it well. Seriously, the stock market is not some magic machine that turns $100 into a fortune overnight. Your job isn't to win every single day. Your job is to control your costs, manage your risks, completely ignore the unnecessary noise, and just give a sensible strategy time to work. So, I'm going to leave you with this final crucial question to chew on. Will your financial future depend on predicting tomorrow's headline or on the quality of the system you build today? Don't try to become rich from investing overnight. Learn how to become an investor first, understand exactly why you're putting your money to work, and decide if you are truly ready to build a financial system you can actually stick with.